The efficient market hypothesis links information to how prices adjust. In its weak form, past prices and returns should carry no systematic linear forecasting power once I account for risk and transaction costs. Here, I want to walk you through the econometric tests of that idea. Everything I say is an academic discussion of statistical models and historical data. It is not trading advice, it does not predict future returns, and it recommends no financial position. Samuelson showed why properly anticipated prices should fluctuate unpredictably, while Farmer organized market efficiency around the information reflected in prices. The intuition is competitive. If a predictable profit opportunity is widely recognized, trading tends to incorporate the relevant information into current prices. Random price changes can therefore be a consequence of active information processing, rather than evidence that markets ignore information. Weak form efficiency concerns historical market information. Semi-strong efficiency adds publicly available information and is often studied through event analysis. Strong form efficiency includes public and private information and is the most demanding. These forms are conceptually distinct. Evidence about autocorrelation in past returns addresses weak form efficiency. It does not by itself establish or reject semi-strong or strong form efficiency. Behavioral finance emphasizes biases, limits to arbitrage, and institutional frictions that can produce departures from ideal efficiency. Modern empirical work therefore treats efficiency as a testable approximation rather than an all-or-nothing law. Statistical predictability may coexist with small economic gains after costs and risk. Conversely, failure to detect predictability can reflect low power. The hypothesis must be tied to a specific information set and forecasting rule. A simple random walk says that price at time t equals price at time t minus 1 plus a mean 0 innovation. A random walk with drift adds an expected change. Iterating the equation shows that current price equals the starting value, accumulated drift, and the sum of all innovations. The price level is I1, while its first difference is the innovation and may be I0. Expected returns need not be literally constant. They may vary slowly or respond to conditional risk. At higher frequencies, a constant or negligible drift can be a useful approximation. At quarterly or annual horizons, modeling expected return may be more important. Rejecting a zero mean return model is not the same as finding exploitable inefficiency. The benchmark should allow economically defensible expected return variation.